Last week's close saw the S&P 500 print at 6,879. Now, it defended its 50-day moving average on paper, but if you actually look beneath the surface, there is a serious crack forming in the foundation.
Yeah, a massive crack.
Exactly. It is Sunday morning, March 8, 2026, and we are prepping you for tomorrow morning's opening bell. For today's deep dive, we are working off a stack of highly confidential institutional strategy briefings, specifically the Bulls, Bears, and the Bell March 2026 strategy briefing.
Right, and our mission today is really to act as your translator on the weekly time frame.
Because we are decoding a market that is currently caught in a violently unpredictable tug of war. On one side, you have a fading AI hype cycle. On the other, incredibly stubborn inflation. And dropping right into the middle of all that is a sudden, massive geopolitical shockwave.
It's a lot to process.
It is. So we are going to cut right through the heavy financial jargon and reveal the actual game plan that the smart money is deploying right now.
Because the market sentiment heading into tomorrow morning is technically neutral, but, it is an incredibly fragile neutral. We are transitioning fast out of outright fear and into a very skeptical show-me state.
Right.
Institutions just aren't blindly buying the dip anymore.
And the tape from Friday shows exactly that. The S&P defended that 6,879 level, but the large-cap tech sector, the absolute darling of the market for 2 years, just experienced a brutal 1.4% liquidation.
Okay, let's unpack this. Why is the smart money suddenly fleeing the Magnificent Seven?
Because we are officially entering what institutional desks are calling the Great D-rating.
The Great D-rating.
Exactly. The whole AI at any price era is just, it's over. Investors are no longer buying the hype or the press releases. They are demanding actual tangible proof of productivity gains to justify these massive valuations.
Yeah, and the hard numbers completely back that up. Let's look at the Nasdaq 100. The NDX has officially broken its ascending weekly trend line, a line that had been firmly in place since late 2024.
Which is a huge structural shift. Huge. And it's being driven by AI displacement fears and these massive capital expenditure revisions. The NDX is now testing critical support down at 22,130.
If we connect this to the bigger picture, what you are seeing is the widening of a K-shaped economy.
Explain that for the listener.
So think of the letter K. On the downward slope, you have software and consumer discretionary stocks getting absolutely hammered by high interest rates.
Right.
But on the upward slope of that K, heavy asset, low obsolescence companies are booming. The physical economy is catching a massive bid while the digital economy gets repriced.
Which brings us perfectly to the biggest catalyst we are tracking right now. Zooming out from the tech sector, we have this geopolitical black swan that hit over the weekend, Operation Epic Fury.
Yeah, centered right around the Strait of Hormuz.
Here's where it gets really interesting. Look at the institutional volume footprints from last week. Volume was 15% above the 20-day average. But the institutions weren't just panic selling.
No, they weren't.
They were executing a highly tactical de-risking rotation out of AI dreams and parking that capital directly into real-world assets, specifically energy via the XLE and defense via the ITA.
And that rotation creates a deadly domino effect. We are looking at a 20% spike in oil prices over the weekend. That spike is the silent killer to the entire disinflation trend.
Totally kills it.
It drove the 10-year U.S. Treasury yield to an aggressive breakout of 4.15%.
Shattering its recent range.
Exactly. And now it's heading straight toward 4.30%. To contextualize just how extreme this is, crude oil is now so overbought that its relative strength index, its RSI, is hitting levels we literally haven't seen since the 1990 Gulf War.
That is wild. 1990 levels.
Yeah, the market is pricing in an absolute worst-case scenario.
So if you are listening to this and thought navigating that geopolitical news was enough for 1 week, get ready for the red folders. Because we are staring down a triple threat inflation wall.
Resetting the deck entirely.
Exactly. We have 3 back-to-back inflation prints coming up that will dictate everything. First up, Wednesday, March 11, we get February U.S. CPI. Forecasts are showing incredibly sticky inflation at 2.8%, with consensus headline at plus 2.5% year over year.
Right.
Then Thursday, March 12 is PPI. We're watching for sticky services costs there. And finally, Friday, March 13th is the PCE price index and Q4 GDP, where core PCE is actually expected to heat up to plus 3.1% year over year.
And these prints create a binary pass-or-fail outcome for the market. If the data comes in hot, let's say core CPI is greater than 0.3% month over month, it completely kills the Fed pivot narrative.
Dead on arrival.
The 10-year yield pushes toward 4.5%, and growth stocks will just spiral. But conversely, if we get a cool print core CPI under 0.2%, it creates a massive risk-on relief rally. The market would instantly price in a 25 basis point cut for the March 18th Fed meeting with 90% certainty.
So let's look at the sector directly in the crosshairs of this binary outcome. Real estate, the XLRE.
Oh, they are critically vulnerable right now.
Why is that the epicenter of the risk?
Because a hot inflation print pushes 30-year mortgage rates right back towards 7%. That effectively kills the spring selling season before it even starts. It makes REITs real estate investment trusts a massive value trap. They desperately need those lower rates to refinance their commercial debt.
So it's a structural nightmare if rates stay higher for longer.
Exactly.
Let's shift to how the smart money is actually positioning for this chaos. Looking at the commitment of Traeger's analysis, it shows speculators are basically all in on chaos.
They really are.
They are pushing net long exposure in WTI crude to a 33-week high. We're talking 172,000 contracts. And at the exact same time, they are heavily shorting the US dollar.
What's fascinating here is how the smart money reacts when retail and speculators get this crowded in one direction.
Yeah.
The commercials are actively hedging against it.
Taking the other side of the trade.
Right. The geopolitical premium in oil has basically become a ceiling, not a tailwind anymore. Everyone is already on one side of the boat.
So if everyone is long oil and short the market expecting World War III, what is the pain trade?
This raises an important question. What happens if consensus is just wrong? If there is any cooling of geopolitical tensions or a diplomatic corridor suddenly opens, that entire war hedge collapses.
The de-escalation squeeze.
Exactly. That would trigger a massive short-covering rally in the beaten-down Mag 7 and a completely brutal liquidation of those crowded energy longs.
So what does this all mean? Let's distill this into the exact game plan you need for tomorrow morning.
The ultimate tactical advice from the institutional sources is this: keep your positions extremely light until Wednesday's CPI.
No hero trades.
Do not make hero trades.
Yeah.
Above all, you have to watch the S&P 500 pivot at 6,800.
That's the line in the sand.
It is. If we lose 6,800, the soft landing narrative dies, and we test 6,550. But if 6,800 holds and the dollar stops rallying, the pain trade is going to be higher.
Okay, to quickly summarize the incredible tension in the market right now, you are navigating a tape caught between the definitive death of the AI at any price era, an oil spike hitting 1990 extremes, and a binary inflation week that decides the Fed's next move.
And that leaves us with one final, frankly provocative thought to ponder. With institutional smart money actively abandoning the Magnificent Seven for energy and defense, at the first sign of real conflict, are we witnessing a permanent structural shift?
A shift away from digital.
Right. A shift where the physical economy reclaims its dominance over the digital economy, regardless of what the Fed actually does next.
That is a fascinating narrative to watch play out. Thank you for joining us for this deep dive into the March strategy briefing. Remember to keep your stops tight, manage your risk, and keep your eyes on the data. We will see you at the opening bell.